You're listening to Indications by the Conference Board.
Hi, this is Jonathan Liu. My guest today is Lynn Franco, our Director of Economic Indicators and Surveys here at the Conference Board. And the topic is consumer confidence in the U.S. Reflecting the American economy as a whole, the Conference Board's Consumer Confidence Index has seen a really remarkable decade of slow and steady expansion since the financial crisis. In February 2009, the index reached an all-time low of 25.3 points. Last fall, October 2018, it peaked at 137.9, just points away from its all-time high. Since then, it's fallen to 124.1, following a sharp 7.3 point decline this March. Is this just a blip? Is it a sign that recession is right around the corner? Or is it something in between, or something more complicated? On today's indications, we're going to try to answer those questions. But first, Lynn, can you give us some background on the Conference Board's history with the Consumer Confidence Index? Where did it come from? What does it consist of? What do you look for? What are the components?
Well, the Conference Board Consumer Confidence Survey is a proprietary survey that we've been doing since 1967. It started out as a sort of a bi-monthly survey and became a monthly survey in mid-1977. And basically what we wanted to do is get the pulse of consumers, since they've been pretty good forecasters of recessions. And we developed this survey that takes a look at both their assessment of the present situation in terms of looking at business conditions and employment. And then we asked them their expectations 6 months out regarding business conditions, employment, and personal income. And those questions have pretty much held steady throughout the entire 50-something year history of the Consumer Confidence Survey. And both components, or the subcomponents, the present situation component and the expectations component, are widely watched as well and very important in interpreting the overall Consumer Confidence Index.
And so with all the numbers that I gave out on the top of the program, those numbers are all indexed currently to 1985. So 100 matches the conditions that existed in 1985. Are there particular levels that you look at through history that represent a strong economy or a weak economy in that basically 100-point or over 100-point scale?
Yes, and we picked sort of 1985 because it was neither a peak nor a trough in the business cycle. And so generally what we've seen is that readings of 90 or above are indicative of a strong to very strong, healthy economy. Usually when the index dips below 80, we're sort of getting into sluggish, slowdown territory. Of course, there's a lot of nuances in sort of reading the tea leaves. And so obviously the trend is a very important player in this consideration. So we need to see, what direction is confidence moving in. If we're down in the 20s, 80 looks like a very good reading. If we're at 120 and we're suddenly at 80, we're heading in the wrong direction. So that is, I think, very important, putting that into context, and also taking a look at sort of, what's happening. I mean, we've had instances where very recently we had a government shutdown. You had a very sharp decline in consumer confidence. It wasn't a recession signal. We've had these in the past. We know that these type of shock events have sort of a temporary impact on consumer confidence, and then we look for the bounce back.
And we've seen that in the past with like Hurricane Katrina, I think was one of them, the fiscal cliff a few years ago.
Yes, as we look back, unfortunately, you see there's a long list of shocks, but I think it
just takes a few months for it to return to its normal level. Yeah,
right. 1 to 4 months generally we see it, and that's where sort of the sub-indexes become very important. Generally, you get less of a decline in the present situation, more in the expectations. That tends to be the shock absorber. So again, it's kind of, reading between the lines, it becomes very critical.
Right. So our overall level now that I mentioned at the top was 124, which is down a bit from where it was 6 months ago, but that's still firmly in very strong territory for the economy.
Yes, it's still in territory that we consider, expansionary. So we think the economy is going to continue growing. However, we have seen a softening in consumer confidence since, late summer, early fall, which I think is in line with what our forecast is and a lot of other forecasts is that there's going to be somewhat of a softening in economic growth over the coming months.
And historically, the index is one of the most closely watched measures by policymakers, by the market in general. What's the track record of consumer confidence in predicting where the economy is going? Is it like how much of an early picture does it provide?
You can sometimes get, 6 months or a little bit longer lead. I mean, consumers have been very good forecasters of recession. They know when the economy is slowing down. It's almost like, you're going 85, on the highway, and
It's
suddenly
like hive
you're,
intelligence.
yes,
Everyone
and
just feels
suddenly
it.
you're at 20. They know. A little less, let's say, when you're picking up speed. So when you're going from 25 to 35 to 45, a little less differentiating. But that's when the two subcomponents come into play, because they behave differently depending where we are, if we're in a downturn or if we're on sort of the recovery path.
So let's get into that. As I said, in our latest reading in March, the overall number was 124.1. The present situation index was at very high 160.6, but down 12 points. Expectations held more steady at 99.8. Well, first of all, how unusual was that the sort of decade-long run that I mentioned at the top of the show?
It's impressive. As we know, we're in one of the longest business cycles ever.
So from an all-time low to really for the past 10 years, really.
Right. And it took quite some time to get back up to sort of, quote-unquote normal confidence levels, because we were so low following the shocks that we experienced during the financial crisis.
And what's happened in the 6 months since?
I think what we've seen right now is a bit of softening in terms of both economic growth and sentiment. I mean, the last few months themselves have been a little bit volatile. We've had some more than usual volatility in the financial markets. We had the government shutdown. We had a very weak February jobs report. So I think we're picking up a little bit of this sort of noise, so to call, in the confidence index, and that's why it's sort of important to really look at the trend. And I think what we're just seeing here is that we had very strong growth last year, and it seems to have eased somewhat into Q1, and probably will ease a little bit more as the year progresses. And I think consumers are sensing that.
And again, in March, we saw the index fall 7 points overall, but the present situation index took the biggest hit. What does it tell you that the trend in the present situation and the expectations are diverging a bit?
Well, it's very unusual for the present situation index to fall 12 points. Usually that happens during a recession. There have been other instances, for instance, Hurricane Katrina, where we saw it fall more than 12 points. So I wouldn't sort of, sound the alarms at this particular moment, especially since the expectations only fell by about 4 points. Everything bears watching as the months progress, but I think for now, a reading of 160.6 is historically very strong, and I think it just really says that the economy is going to continue to expand, probably not at above 3%.
As you mentioned, the survey that produces this number is actually a really extensive survey that has questions that are kind of cover the gamut from purchasing decisions to just an overall feeling of where the economy is. Let's get to what many would think is the most important element of that is jobs. What are the numbers they're showing?
I think what it's showing us is two things. That the job situation is very strong, very favorable. At the same time, we know we're having a shortage, so we have seen a bit of an uptick in the percent of people who say jobs are hard to get. But overall, the labor market remains relatively strong, and we think that we're going to continue to sort of battle these shortages.
And what are the actual
this
percentages there on our
Well, we've got, in terms of people telling us that jobs are plentiful, that's at 42%. And people telling us that jobs are hard to get is down to 13.7%. So these are extremely favorable readings. And so I think while we might have a little bit of noise from month to month, overall the labor market remains very healthy.
And are we seeing that the tightness of the job market reflect expectations of higher wages, which was kind of something that was slow to turn around earlier in the recovery? Are we seeing people expecting to earn more?
Yes, and that's a key point. Yes, it was very slow to turn around in the recovery. And in fact, it was the first time ever that we saw the people more pessimistic about their income prospects than optimistic. And that's never happened before. I think we're just consumers overall are optimistic. Here, I think we have pretty good readings. And actually, this portion of the expectations index did not decline this month. So we've got about 21% who expect an increase, 7.6% who expect a decrease. Most of the people are sort of in that neutral zone and have been for quite some time. So, despite a little bit of the slowdown that we're seeing, people don't think it's really going to impact their income prospects. And that's probably good for consumer spending.
And so in addition to I guess the kind of more direct question of what you feel like your job prospects are, your income prospects are. We also ask people their assessment of the current just overall business condition and also their expectations for 6 months in the future. What are those numbers been showing?
Here, too, I think we're getting pretty positive readings. We've got 33% telling us that business conditions are good versus 13.6% saying they're bad. This, I think, bears a little watching as well because generally business conditions lead employment. So within the present situation itself, there's nuances as well. And we always watch to see if we continue to see softening in business conditions, because that's eventually going to lead to, I think, softening in the labor market. We don't expect that at the moment. We've got, as I said, 42% saying jobs are plentiful versus only 13.7% saying jobs are hard to get. So despite the bit of a softening in business conditions and even in employment conditions, they both remain historically strong.
And what is the sample size of the survey per month?
We have about at least 2,500 or so consumers each month, and that then allows us to take a little bit of a deeper dive into how are consumers doing by age or by income category. We can take a look at
let's cut to that. Are we seeing any divergences between? I think we've got income category, we've got regions, and then individual states.
We've seen sort of a convergence, actually. Okay. So before, I think we had sort of people under 35 were a little bit more optimistic than those, 55 and over. I think right now we've got them all about in the same range. And here, too, the trend is important. And so we've seen pretty much that it's not just concentrated in one age group, which is good. So that tells you that confidence is well dispersed. In terms of the income, for quite some time as we had this recovery, it was really being led by and fueled by the more affluent consumers. And so while they still remain the most confident, we've also seen a pickup in those that are less affluent as well. So at least we know that confidence and I think that the turnaround was a bit more widespread.
And we actually had a previous podcast that dug into the rising incomes among blue-collar workers, which is now outpacing higher earners. So we'll include a link to that in our show notes. Finally, geography, anything there?
Well, I think that's very interesting because generally what we do is we take a look at the 9 census regions that we cover and sort of look for any red flags because, when a downturn is coming, usually it starts to pop up in one particular region and then it kind of spreads before it sort of hits the national figure. There's no real red flags here. I think overall, if we take a look at where we were today versus where we were a year ago, all the regions have seen, a modest improvement. There is some fluctuations, but I think overall we're in a much better position than we were a year ago, and we'll continue to monitor that as well to see if there's any sort of, red flags that come up. The same with the states. We take a look at the states, and overall, I think, there's been some fluctuations, but overall consumers remain relatively confident.
And we also ask people to give, I guess, their predictions for for 12 months ahead on inflation, interest rates, and stock prices. Anything there that stands out to you?
Not at all, actually. In terms of inflation rate, consumers are pretty sensitive to food and gas prices. Obviously, those are the things we are most in touch with, going to the gas station or the grocery store on a frequent basis.
The price signs are the biggest, I think.
Yes, exactly. A little uptick there, but still lower in terms of inflation where we were a year ago. In terms of interest rates now, I think now that the Fed seems to have paused and said they will pause for the remainder of the year, not much volatility there. We did have a lot of movement sort of in terms of stock prices, and that coincided with a lot of the stock market volatility that we had a few months ago, and that sort of has corrected itself. So
currently it looks like 36% predict stock prices to increase in the next 12 months. 37% predict stock prices to be the same, and then just 25.7% predicted decrease. So it's looking overall pretty positive.
Right, and if you think, just in January, 37.5% expected stock prices to decrease. And
that was during that moment of real volatility in the market.
Exactly. So that seems to have dissipated, and eventually it comes back to what's happening in terms of the labor market. That's always a key component of consumer confidence and incomes as well.
Okay. And finally, we also look at individual purchasing decisions. So who's going to buy a car, buy a house, go on vacation in the next 6 months? Anything there that stands out to you?
I think in terms of, automobile purchases, a little bit maybe of a, softening. But again, that's an interest rate driven industry. So nothing to set off any alarms there as well. Home prices, obviously, if we have an uptick in mortgage rates, that's going to impact home purchasing intentions. The supply of homes also has an impact, as well as the barrier for first-time buyers. So we've seen some softening in the housing market, but again, nothing that we think is really going to significantly deteriorate.
So it sounds like, Lynn, overall that just in absolute terms, we're still in a really strong economy. The numbers, especially the present situation index, is still extremely high. But we're getting more mixed signals in the immediate past few months. Based on the evidence that you've seen so far, can you lay out for the rest of 2019, what are some like the best case scenario and the worst case scenario?
I think the best case scenario is that, we'll see somewhat of a slowdown in terms of growth to somewhere, in the 2.5% range. We'll probably continue to pick up some noise in terms of consumer confidence. It's probably not going to improve significantly. I don't think it's going to deteriorate significantly either. I mean, the one factor that could always impact is a shock, and we can't foretell those. And so I think for the time being, at least what we have is a confident consumer, one that isn't as confident as they were a year ago, one who anticipates a bit of a slowing in economic growth, but not a consumer at this point that foresees a recession.
Interesting. Okay. And the worst case scenario, or
the worst case scenario is perhaps a shock. Then we see a significant deterioration in consumer confidence, which then causes a significant pullback in spending, and then could have negative consequences for the economy.
So as we put out the Consumer Confidence Index the last Tuesday of every month. And obviously, you're also tracking a bunch of other indicators from the government and elsewhere. What are you looking for that will kind of narrow down your forecast in the months ahead?
I think we look at a variety of factors. We've got, the Consumer Confidence Index. We've got the leading economic indicators that we look at. We've got our Employment Trends Index. So all of these, I think, are important and get rolled up into our overall economic forecast. And in all of these areas, I think what we're seeing is, signs of softening, but not signs of any sort of, significant deterioration or slowdown.
And so if anything changes, we'll have you back on Indications. But for now, thank you, Lynn. I've been Jonathan Liu. This has been Indications. See you soon.
This has been Indications from the Conference Board.